What's up guys, Cameron here. In today's video, I'm going to give you 5 steps on how to get into investing so you can enjoy retirement in your 60s without relying on Social Security. So like and subscribe and let's get after it. Number 1, invest in your job's 401k. Your 401k is going to be your gateway into investing, your introduction of sorts. Depending on your position, you'll be eligible to take part in a 401k. And if your job offers a match, take the match. That's free money. That match is going to help your 401k grow faster. Now, how much you should contribute? It depends on the percentage that your job matches. If they match 5%, contribute 5%. If you want to add more, you can, as long as you have enough money on your paycheck to cover bills and the rest of your needs. That's number 1. Number 2, finding a brokerage. So we got our 401k with our employer. Now we need our own account to invest in. There are a lot of brokerages out there that people use. You have the new gens like Moomoo, Public, Webull, and Robinhood. And the old school brokerages like Fidelity, Vanguard, and Charles Schwab. When people starting out, Robinhood is always recommended because how simple the platform is. I don't necessarily have a problem with Robinhood. Like I said, it's beginner friendly. And they also introduced the Roth IRA match, which is very dope. If you get Robinhood Gold for $5 a month, you get a 3% match. If you don't, you get a 1% match, which is still good. That's free money. But the problem with Robinhood is they have a bunch of day traders on their platform. When you go on YouTube, every day trader uses Robinhood. And also, Robinhood promotes gambling. Yes, an investment platform promotes gambling. Example, they had a bet if the Federal Reserve will cut or raise rates. Ridiculous. And the last straw for me, they don't have a live person to call if you have questions or problems with your account. They have chats. I need to talk to a human being. So I don't recommend Robinhood for long-term investing. I recommend the big 3, Fidelity, Vanguard, and Charles Schwab. They've been around longer. You can call a human. All 3 are huge asset managers. So there's that. Let me know in the comments if you guys like Robinhood or hate Robinhood, and let me know your thoughts on it. Number 3, opening a Roth IRA. Like I said earlier, I want you to enjoy retirement, and contributing to your Roth IRA will do that. In 2026, the new limit is projected to be $7,500 for ages under 50, which is a $500 increase, and $8,600 with a $1,100 catch-up for ages 50 and older. And you can withdraw this money tax-free at 59 and a half years of age. What makes the Roth IRA so powerful? Your investments grow tax-free, and your dividends are free from federal taxes as long as you don't withdraw early. Why you think they limit the Roth IRA? It's a complete cheat code from paying taxes. Like, if you just imagine if there was no limit on the Roth IRA. All these billionaires and multimillionaires, majority of their wealth would be in a Roth IRA to avoid paying taxes. Trust me, bro, the Roth IRA is so powerful. So get the Roth. Number 4 is simple, fund the account. You can't buy anything without money. And since we open our Roth IRA, we need to max it out. Obviously, people's incomes are different from one another, but I just want you guys to build a habit. If you get paid weekly or bi-weekly, start off with $5, $10, $25, $50 every time you get paid. Once you get comfortable and maybe making more money, increase the contributions. I want you to make it a habit. Better yet, automate it so you don't have to do all the work. Automation goes a long way. And for the final step, put it all together, buy your first stock. Stocks are basically pieces of a company that is public on the stock market. When you buy a share of that single company, you become a shareholder. And yes, You are part owner of that company. Sounds pretty cool, right? You have individual stocks and ETFs or index funds. Individual stocks are your Apple's AAPL and Tesla's TSLA. Companies with massive growth opportunities, but have massive losses when there is like a down market. If you can't handle a 10% or more loss on your stock, then ETFs and index funds are your best bet. ETFs and index funds are funds that holds a basket of companies. Example, VOO. VOO is the Vanguard S&P 500. It holds 500 of the best companies in the market. What's great about ETFs and index funds, they are actively managed, meaning you don't have to do anything. The fund managers do all the work for you. Which route you should go? I'll say if you can't handle the downturns and want to do the research, if you can handle the downturns and want to do the research, choose single stocks. But if you want to be hands-free and set it and forget it, choose ETFs. Since you guys are new, I will recommend starting with index funds and ETFs. So, just to get a feel for it. And once you get comfortable, then you can dabble into single stocks. But if you don't want to, that's fine. Either route is good as long as you are investing and doing your own research. So there you have it. Those are my 5 steps to get into investing. Let me know in the comments what you guys like between single stocks and ETFs and what brokers you guys like to use. So like and subscribe, keep God first, and I love you guys. Peace.